All right. Good morning, everybody. So it continues. We had a lot of news in the last 24 hours. Chips are still doing really good. Everything just continues to grind to the upside. Hopefully, you guys didn't get too heavy short, right? Because the shorts ain't working. Individually, there's still a lot of good shorts out there. You know, you can pick and choose. I had a nice Google short, but we can't get all bared up. Not yet. Not the time. We can see the Dow is basically flat with the UK and Hong Kong just not getting anything done there. S&P up a quarter, Japan. Then we got the Nasdaq, and oddly enough, there it is again, small caps leading in the pre-market. Very likely we're going to see that fade away after we get into the open. That's been the theme, right? At least that's what we've been seeing a lot this year. Small caps doing the work in the overnight and then just fading back. And once we get into the regular trading session, Germany's actually getting something done, and then Europe up at the top, 1.5%. It's like we've talked about before. If we see a influence after 2 a.m. when Europe opens, watch for them to close before noon today. If their influence moved us in a particular direction, higher or lower, once their influence is gone, we'll often see the market unwind some of that move. Considering the data we've gotten so far this week, this day is going to be a little quiet, but we're still getting data. We're going to get a little bit. I don't think we get all of these, right? Because with the government shutdown, we very likely won't get everything. We could possibly, because this is old data. So maybe. But we're going to get Lori Logan, another Fed member, chipping teeth, some soft data, anything job related. Remember, you want to pay particular attention to that. So if we get all of our data today, it'd be a little bit of a surprise, I guess. Otherwise, we'll make it through today with an eye on tomorrow. That's tomorrow's going to be a much bigger event. There won't be any votes today in the House and the Senate to get the government back up and running. They're out on holiday. So we shouldn't have any headline threats from that direction. It doesn't mean we can't get headline threats from something else, but at least we have that one off the table. Keep your eye on the 2-year treasuries today. And by the way, with the move that we saw yesterday, it really helped out on that drive higher. So if we start to see weakness in the 2-year now and it begins to fade back, that could be an early warning that we're going to lose the rally. Tesla is going to get some car data today, which should pair nicely with the headlines of yesterday, where they talked about the increased subscription costs. That's what gave them a boost. We breached one of the major options levels yesterday, and so the call wall rolled up. It's not rolled up a lot, but it did roll up. So if the put wall had not rolled back down if it had stayed elevated from the roll up that we saw earlier this week. And then we had a call wall rolled up right behind that. I would really like that. That would be a very bullish indication. But we gave up the put wall and it rolled back, and then we had the call wall roll up, and that kind of takes out some of the mojo, right? It's not so bullish to have that, simply because it looks like they're just widening the alley or the buffer around price. So now we've got the call wall at 6,800, basically, just rounded a little, and the put wall at 65.50. 225-point range. And it extends from the 50 period daily, that's 55.50, the put wall, to 67.75, which is where we are, 6,800. So another 25 points higher than where we are right this moment. That's a wide range, right? Now, one of the things about this range that should be pretty obvious is that we're in the upper part of the range, right? We're not near the middle to test the middle ground. We're up against the edge. So there's this logic, especially in the options market, about where we can go from here. And a lot of the options logic, if you think about implied volatility, things like that, they'll say, oh, volatility is high, it has nowhere to go but down, or volatility is down, it has nowhere to go but up. And we know that technically that's not true, because if it's down, it can stay down. If it's up, it can stay up. It doesn't have to go back the other way. When it comes to price and you've already had a run, one of the things that analysts like to talk about is the what's more likely scenario. And this is kind of a false trap. And it comes back to understanding statistics and probabilities. It's the old coin toss discussion. If you pick up a quarter and you go to flip it, heads or tails, how likely is it that you get heads? Well, if you get heads this time and you go to flip it again, how likely is it that you'll get heads? You just had heads. Shouldn't it be less likely that you'll get heads a second time? So suppose you do get heads the second time and then you flip it again. How likely is it that it's heads? You just had two heads and you really think you're going to get a third one now? The the problem with that way of thinking is every time you flip the quarter, it only has a 50-50 chance. The odds don't skew just because of what you had previously, right? If you had 9 heads in a row and you go to flip it for the 10th time, it's still a 50-50 shot you're going to get heads. Doesn't matter that you had 9 heads before. It's a 50-50 chance that you're going to get heads this time, because that's the odds, right? So when we're up against a restrictive level like this, when we've had 5 green days, well, 4 because today doesn't count, when we have multiple days in a row in a single direction, what's the odds that it continues to push in the same direction, right? It kind of goes back into that sort of logic. It is easier for price to move in a direction where it has the least amount of resistance, like water rolling downhill. So follow the path of least resistance. That's a downside move and not going through 6,800. But the model continues to show we're headed to the upside. And until that changes, we want to run with what we've got, not with what appears just like, 9 heads in a row and looking at the 10th coin toss. You might want to choose tails just because you've already had 9 heads, but that's just the path of least resistance, and it's not what we have. It's not reality. Don't mistake this for a short, is what I'm trying to get to here. Yeah, taking the short makes sense. we've got a lot of reasons to think this is a good time to get short, but we don't have any short signals, right? We don't have any short signals. 65.5 is what we've got on the overnight volume. That's pretty good, all things considered. It's not as heavy as yesterday, but 60s is more normal, and yesterday was more unusual. So I'll take normal any day. We had talked about this being a TRB, right? And if we were looking for it to be a TRB, we would have made the move in a single shot. So either the day after this red one, or once we consolidated for a day, the next day. That would have, either one of those two bars going all the way to the top would have been our TRB. We didn't get it. But I did mention that even if we don't get the TRB, it doesn't take off the idea that we could go to the top here. And we got that done, right? We also had this really big outsized bar. That really big outsized bar is a concern, right? It is. It's a really big outside bar, but it closed in the upper part. It closed above the moving averages, and price now is inside day breakout of the previous day's range, and we are broke out of this bigger range. So run with what we've got. We are already above the 111. We've got the 1236 overhead at 87. If we can overshoot that, we've got the 6,800 call wall up there. And so far, there's no reason to believe that we can't just go on up there and get it done. There is just so much money coming into this market that continues to come into this market. And we see every day funds, firms, institutions completely ignore all risk and put more money in this market. Sorry, guys, I can't type and talk at the same time. I can't chew bubble gum and walk. Looking to that upside as we've got the ADR half up here, 67.84. With 67.84, if we get there early enough, we can go to the other side by the end of the day. I know that looks bearish. I get it. But it's not bearish. It's just a part of the wave function. It's just how price moves, right? We wouldn't consider that a bearish outcome. But we have to do it first, right? So the idea is let's get up into that 67.84, fail to get above that and expand higher, and then we'll look for a retrace that starts with getting back inside of yesterday's range, breaking our own Globex low, taking out the Tuesday high, and then coming on down into that 67.32 cog line. Step by step, right? Now, this is sort of a rising wedge. It doesn't look like much of a wedge, but if you stretch it out there a little bit, and these generally break to the downside. The problem with that logic is with these sort of rising wedges. is that sometimes instead of falling down, they will first pop up and give us some sort of blow off top style move, and then they'll come down, right? So keep that in mind that it doesn't have to just fall out of the bottom. We could get a fake breakout or a blow off top sort of scenario and then get the move lower. When it comes to these sort of rising wedges, I've got my own little issue with this part. Wrong one. We'll get there. With this section right here, I got this theory that we don't want to get into the last 20% of this. The apex is what I call it, but I don't think that's the right word, really. We don't want to get into that part of the zone, okay? If you have a wedge, whether it's rising, falling, sideways, it doesn't matter what kind of wedge it is. You don't want price to get into this area here. If you do see price get into that, it negates the pattern's setup. So we wouldn't expect it to follow through the way that it typically would follow through. On the one hand, that sounds really cool, and I've got a lot of examples where I've proven that to be right. On the other hand, when the wedge isn't really all that good anyways, right? We have to keep trying to zoom into this one and negotiate the way that we're going to do the lines. If it's not a very clean wedge to begin with, then the apex area that you're trying to look at is also not a very good apex. So then it's harder to define, are we in that last little area that we shouldn't be in? That's why then the better the pattern, the better the analysis, right? The better the follow through. And you could consider it the old chicken and egg scenario, right? If did the head and shoulder work because everybody saw a head and shoulders and shorted the market, or did the head and shoulder work just because that's what price was doing and then it moved in the right direction? I argue that it's the latter. The head and shoulders work because that's just what price does. It's not because people saw it. I come up with that from an old book I read, and I wish I could remember the author. I would give attribution where it belongs. But you know, trading's been happening since way back in the day, right? Since before the United States even existed, there was trading going on. So a company years ago went back and crawled through the old trades that had happened in Europe. And that was before candles, right? There was no charting. There was just ledgers. That's all it was just numbers on a book. But if you charted out those trades from the ledger and you basically marked out highs and lows and opens and closes, you had price patterns even back then when there was no chart to be seen. People weren't trading a head and shoulder because the head and shoulder pattern didn't exist in the lexicon. People didn't talk about it. They didn't have a pattern, a chart to see, to know that there was such a thing as a head and shoulder. And yet head and shoulders existed. So did wedges and ranges and breakouts and false breakouts and every pattern that we trade to this day. Price makes those patterns. So the outcome of those patterns is not defined because people saw them and traded them. Although, you know, there is some of that, I'm sure, now, because we have charts and patterns and the recognition. But they always did exist, even before traders knew that they existed. So I guess the answer is chicken, right? Chicken came before the egg. Okay, so far today we have an MDP. That's a missed daily pivot. The daily pivot is 67.35. Today's floor pivot is higher than yesterday. That's bullish. Price opened above it. That's also bullish. Price wants to hit this pivot. It does that most of the time. It's what price generally does. and it won't count as an MDP until tomorrow. We have to get through today without hitting it, and then look back at tomorrow and say, hey, look at that, we didn't hit it. So until then, it's a possible missed daily pivot. The wide channel implies that if we get a breakout, the breakout doesn't stick. We already have broke out, by the way. So that implies we're going to come back in. And the fact that it is a missed pivot implies that if we do come back in, we're going to come on down here and hit it, and then it won't be a missed pivot anymore. It'll be a hit pivot. So that's what we want to focus on. Get back inside of yesterday's range, break our own Globex low, get through this channel, and then get to this pivot. At this point today, that's the base case argument, is that we're going to just come on down here and get that. Now, having said that, we've got yesterday's 111 as a focus, and we can measure that 111 using the smallest measure possible, which is just yesterday's RTH. Or we could measure all of yesterday, and that would give us a bigger 1, 2, 3, 6. But if we break through the 1, 2, 3, 6 up here, and we continue to go higher, like we did yesterday when we broke through yesterday's high, we hit the 1, 2, 3, 6 right there, and then we pulled back and we just legged up into a whole other run higher. So if we get to this 1, 2, 3, 6 and we pull back and then we run up and we break that 1, 2, 3, 6, then the idea that we're coming down here is off the table. But for now, that is completely what I'm expecting, that we top out here. We either fail at this 111 or we make it through 111 and we get to 1, 2, 3, 6, and then that's it. From there, we can just stay up here in base. We don't have to go lower. We can just stay right here for the rest of the day. I find that idea to be a bit difficult. Or we break down and we get this floor pivot. There is also the concern of the SNRs today, how far we moved yesterday. Expands how far the SNRs are today. 6792 cog line is R1. We don't even want to get there, let alone get above it. If we get above that R1, I think we stay above it for the day. You see the R1 of yesterday, when we got up there, we hit it, we rejected, and then we just ripped right through it and we stayed above it. We almost got to R2 by the end of the day. But there's the S1 R2 that I was talking about, right? Sure, we overshot the S1, but when we got back inside it, that became the S1 R2. You can catch yesterday's replay where we talked about this, right? But we are not at R1, and that means this is our playground. R1 to S1 with the floor pivot down here. The floor pivot is supposed to be in the middle, but as you can see, the upside has more room than the downside, and that's because this indicator is smart enough to point direction. And directionally, it is saying we've got a greater likelihood of going up than down. We don't really have a lot out here. other than if we break to the downside through all that Globex stuff, 6750 has a lot of work from last week. The problem is it's pretty shallow this week, and we moved through it already without even a speed bump. We hit the bottom of it, pulled back, and then we cut right through the entire thing and came out of the top. It is worth noting this big block here. On this time frame, that big block doesn't really stand out, right? We got this area here and this area here. These are much bigger, but make no mistake about it, this is really big. And then, of course, you've got that pattern right there. It's a really strong reversal pattern. And we're inside of that pattern now. Oh, no, we made it back out. Good. Never mind. If we do come back down, get inside this, this is going to be an area of concern now. Ten-day, 30-minute volume profile and TPO. We can see the large amount of trading that came in yesterday. That block is easier to see here. They were putting a lot of work in yesterday afternoon when we ran up into that zone. We talk about quite often when we have these reversals off the highs or the lows of, did the buyers step in at these lows or did sellers get exhausted? And did the sellers step in at these highs or did buyers get exhausted? Well, this really looks like sellers stepped in at this level, not that buyers got exhausted. That huge chunk of activity right there. But we're through it already. And now we got to be mindful of traders' remorse and them defending the level. The point of control is still not changing its location. We're going to get into these candles at some point today, and it's possible that we could see a new location by tomorrow. I don't believe that, but it is possible. I think we're going to stay right at that level until at least the end of the week. We wiped out that 6750 VPOC line. We're done with that. We don't have a new VPOC because we've cut through that area multiple times already today. They put a lot of work in on this breakout, trying to hold it back, and we cut through it anyways. No real discrepancy here. Nothing shows up as a warning or concern. All's quiet. We are nearing the upper edge of the weekly expected move. This is how far we had projected last Friday that the market would move this week. We're supposed to close inside this range 70% of the time. That's a one standard deviation range, right? So it's like 68 point blah, blah, blah. We just round up and say 70. 70% of the time we should close inside this. So an easy math is to just count back the last 10 weeks and count how many times on Friday we closed outside of the box. There's a couple issues with this count process if you're going to attempt to do it. One is this indicator acts a little screwy when it comes to contract change events. So that sort of behavior here where it's really scrunched together, that was right after a contract change, or right here, right after the contract change, and right there, right after the contract change. You get the idea. There's also a problem with holiday weeks or short weeks. So if you're counting back and you're trying to see how many Fridays we closed outside the box in the last 10 weeks, my tactic is not to count these broken weeks and not to count short weeks. If we was to do that, however, then we have one breakout week right here. That's one in, one out, two in, 3, 4, 5. That's 2 out of 7, 3 out of 8, 9, 10. That's 10 weeks. And if one of those was a holiday week, I missed it. But that's 10, and we didn't get beyond 3. 3 out of 10 closed outside. That's our 70%. If we had counted back and we had more than 3 that closed outside the box, we would have to be more concerned about volatility being priced into the market, or market makers failing to price volatility into the market. We can lean a little heavier on this range because this range is proving that things are functioning the way it's supposed to. It's a very efficient market out there, right? And it's a fair market. I know a lot of people might argue with that, but the options and the trading is a very fair and balanced and efficient market. We're still 3.25% above the 10-week. We're not into the extremes. If we set the mouse there and look to the left, we've been higher than this many times before, and it doesn't end up with some violent reversal to the downside. We're not overstretched. We're not overbought. We're not overextended. On the weekly, we're good. Now, sure, we're a little high, 3.25%. That's a bit high above the 10-week, but not high enough to be considering that we're overbought, overextended, or that we're due some sort of mean reversion to the downside. This says, nope, we're good. Now, the daily is something completely different. But on the daily, we're not even 1% away from the 10-day yet. Not even 1%. If we're still within 1% of the 10-day, we're in the sweet spot. It's like sitting on the interstate with the cruise control at 80. You're good. There's nothing wrong here. So unless we start to see this getting it above 2.5, 3, 3.5, we got no issues with the 10-day, the 10-week. The movement that we've had over the last few days has not been too much. We didn't go too far too fast, and it doesn't owe us anything. So don't be looking for some mean reversion just because you think we've gone a long ways in a short period of time and that we're due for some sort of a pullback. That's the way I started today's stream, by the way, although I failed to do a very good job of it. There's no reason to short this just because we've been red for 4 days. And yes, or just because we've been green for 4 days. Today's also a positive day, but it doesn't count yet because the day ain't done. Shorting it just because is a really bad idea. And I continue to see people do that all the time. Simply because a market has moved in one direction for 4 days, they want to go the other way. Because they have this false belief that, well, surely it's going to go the other way now. That's more of a FOMO from you missing the long in the first place and trying to rush the short just because you missed the long. Looking at what's down this morning, the Mag 7 down volume is down. How's that for a double negative? The VIX is down, but over a 5-day period, it's still up more than 4.5%. So it's a little down today, but it was up like 7%. So 6%. It's still a lot, either way you look at it. But that's really the only thing up there. Healthcare went crazy yesterday, right? Healthcare was like one of the biggest movers, and it's down slightly today, not enough to hit our benchmark. And even with this little bit of pullback, it's still up almost 7%. That's wild, right? You don't normally get those sort of moves in healthcare. That's a flight to safety maneuver, not what we would expect in good markets. looking at what's up this morning, we've got Mag 7, generic tech, robots, emerging markets, which is China again, gold miners, solar, Bitcoin, Mag 7 up volume, China again, quantum, chips, China again, uranium, China. You get the idea. If I was looking for the check marks to define, could today be a bullish breakout day? The answer would be yes. We've got every ingredient we need for an inside day breakout to continue and to have a rally day. We do. We have everything we need. Chips alone could get that done. We wouldn't even need anything else. But then you add in all the push from the China ADRs and the gold backdrop. If you got gold higher, you got equities higher. And then Bitcoin coming in. Bitcoin is the risk factor, right? If they're scared and nervous and wanting to sit out, they won't get into the riskiest asset out there. Then more precious metals, a little bit of frivolous risk like the pot stocks, but a big allocation into Mag 7. So growth continues. We got everything we need for a rally day. Whether it continues is something completely different. Once we get into the open, we'll see what we get after that. But it is, as always, GTFO. Get out of this box to continue to go higher. If we get above yesterday's 1, 2, 3, 6, then we can cancel the idea of a reversal and we'll just continue to focus on an upside move. When we had this set up yesterday, that was yesterday's measurement, and there was the 111 and the 1, 2, 3, 6. We got there, had a nice trade on the pullback, and then it just continued higher anyways. That's what could happen today. The same thing. Now I'm still arguing against it. I don't think we're going to do that yet. If I'm wrong, then I'll take that loss and I'll flip the trade over and I'll go the other way. But for right now, the base case argument is that we don't get through yesterday's 1, 2, 3, 6. And I'll short this 1, 2, 3, 6 just like I shorted yesterday's 1, 2, 3, 6. It worked. I didn't need, 70 points to the downside. I only needed 4 or 5. Keep in mind, this does not owe us a move down, and it does not owe us a move up. This is the quiet day in front of the big data tomorrow that we might not get because of the situation out there. So this quiet period could just be us holding this range and not doing a darn thing. That would be 67.90 to 67.40, that 50-point range, and we could just chop there all day doing nothing. All right. Otherwise, that's what you got, guys. Keep your eyes on the headlines. Be careful. Be safe. I'll see y'all tomorrow.